Okay, and so we are calling to order the retirement board meeting for today, January 21st, 2021, and we are going to look if there's any public comment today. Seeing no and hearing no public comment, we are going to move to approve the minutes from our last meeting. Is there a motion to approve those minutes?
Motion to approve the minutes from the last meeting.
Second.
Been moved and seconded to approve the Thursday, January 14th retirement board meeting minutes. Any further discussion on the minutes? Hearing none, all in favor say aye. Aye.
Aye.
Aye.
The motion is carried. Okay, under old business, we have a brief status update for our investment consultant, and Jason, we'll turn it over to you for that.
Sure. Just a quick update. I sent the questions to everybody yesterday that are due back to the potential respondents tomorrow. So that was just in case anybody had any edits or questions about it. But just to quick update that everything that says please see attached, we're going to be including the investment policy statement because that was a question from a number of the potential proposers. The fourth quarter 2020 performance reports and the Korn Ferry valuation report. They were the only attachments that were asked for by the potential proposers. And finally, we are up to about 32 inquiries. So we did get one more yesterday, but that put us at 32. So 2 weeks until responses are due.
Okay, very exciting. We're looking forward to that. Thanks again for all the coordination and work on that, Jason. Much appreciated. You've been doing a great job with that. Very thankful for that. Thank you.
Sure, you're welcome.
Okay, and so we are going to be then turning into our quarter four for CS McKee report. We're excited to have another year behind us and to take a look back at the not only the quarter but the year that's just preceded us and gone forward, and looking to hear a little bit about the world ahead and what it's looking like for our portfolio. So we will turn it over to the folks from CS McKee. We're happy to have you here. So good morning, and the floor is yours.
Well, great. Thank you, and good morning, everyone. Happy New Year. Hopefully everyone had a great holiday season. We actually had our daughter, son-in-law, 5- and 6-year-old grandkids at the house for 2 weeks. So I am almost fully recovered from running up and down the stairs playing Tickle Monster for the last 2 weeks. So I think you got me at full. Bob is our senior most equity portfolio manager at the firm. What I thought I'd do is, given that this is a year-end review, I'd provide a brief kind of year-end review from several perspectives. Turn it over to Bob to review the equity portfolios. Then I'll go over the fixed income portfolios. We can certainly answer any questions along the way. So, feel free to jump in any way you want. So does that sound good for a kind of an agenda? Yep.
That sounds fantastic. Thank you, Rob.
Sure. Well, let's start with a brief 5-minute 4-stop tour of the country. All right. So we'll make stops at Wall Street, Main Street, Pennsylvania Avenue, and 420 Fort Duquesne Boulevard, otherwise known as CS McKee's headquarters. So let's start with Wall Street. By just about any measure, 2020 was a year of extremes in the financial markets. At the March low, the S&P 500 was down more than 30% from the beginning of the year, but ended the year ahead by 18%. The index has never finished the year with a positive return after suffering a 30% loss during the same year. That was extreme. The S&P 500 rose 15% in the last 2 months of the year. That's the best finishing 2 months in the history of the index. Small cap stocks, as measured by the Russell 2000 index, had the single best quarter in the history of the index in the fourth quarter, up 29.3%. And small caps slightly outpaced large caps with a return of just about 20% versus about 18% for the S&P 500. In the IPO market, IPOs were incredibly strong. 500 companies went public. That's the most since 1999. A couple of new offerings, Airbnb and DoorDash, both came out in December. and shot up 116% and 40% respectively. The yield on the 10-year Treasury bond was cut in half in 2020, going from about 1.8% to 0.9% when most of the world was calling for interest rates to rise. The 10-year Treasury rate actually bottomed at 51 basis points in August. Looking at Main Street, the major issue, obviously, facing Main Street in 2020 was the coronavirus pandemic and the economic impact it had on many people. The first case of coronavirus was reported in the United States on January 21st, 2020, and the first reported death was January 29th. By December 31st, there were just shy of 20 million cases and 345 deaths in the United States. The unemployment rate started the year at 3.5%, quadrupled to 14.8% in April, and finished the year at 6.7%. The average number of unemployment claims went from the 4-week average of unemployment claims went from 210,000 in January and February to 5.7 million in April. Just think about that for a second. I mean, it typically averaged somewhere in the neighborhood of 200,000 plus or minus to 5.7 million, and the 4-week average remains above 800,000 today. In fact, the number just came out for last week. It was 900,000. The percent of people unemployed for more than 6 months went from 4% to 37% right now. The economy contracted in 2020 by approximately 3.5%. GDP went from minus 31% in the second quarter to plus 33% in the third quarter. These are numbers that just wouldn't even have considered just a year ago. Hopes are obviously that everyone can be vaccinated by year end. The Bloomberg consensus forecast for the economy is that it will grow by 3.9% in 2021, but that estimate is heavily dependent on what happens with the pandemic and the vaccine program. So those numbers range from a low of 1.8% to a high of 7.4%. Looking at Pennsylvania Avenue, for the first time since 2011, we have a Democratic-controlled House, Senate, and presidency. So what does that mean for the markets? And the answer is not much, really. Over the last 45 years, the S&P 500 index has gone up an average of 12.89% under Democratic control, 12.95% under Republican control, and 13.64% when split. So not too much of an impact market-wise. The 11-seat Democratic majority in the House is the smallest for Democrats in 140 years. The razor-thin Democratic majority in the Senate really precludes any drastic legislation from passing. They're going to have to compromise. There's no question. They're not going to be able to pass massive, sweeping, one-sided legislation. Congress passed a $900 billion relief package in December. Obviously, they're working on another package. They're talking about $1.9 billion as a starting point. It won't be $1.9 billion. It'll be less than that. And then there'll be, meaningful spending on infrastructure, which will be a tailwind to the equity markets, but a headwind to the bond markets as interest rates continue to rise. Tax reform is coming in some capacity. You increase taxes on the wealthy, most likely increase corporate taxes if they can get it through. But it's unlikely anything will pass until 2022. And then lastly, looking at 420 Fort Duquesne Boulevard, we expect what you may have heard is a K-shaped recovery in the market to continue, where one group of individuals and companies prosper while another group continues to struggle. We've reduced exposure to risk assets in our fixed income portfolios as those sectors have appreciated and become somewhat expensive. We think the vaccine rollout will help the COVID casualties, i.e. value stocks, at the expense of the higher flying pandemic plays, i.e. growth at any price, and we've positioned the equity portfolios accordingly. So I will stop there, as that's a good jumping off point for the equity review. But before I do, does anyone have any questions about big picture, what we see, the firm, or anything like that.
No, that was great, Rob. Thank you.
Yeah,
Okay,
thank
sure.
you.
All right. So with that, Bob, do you want to jump into the equity portfolio?
Sure. And, just obviously it was a very, very volatile year. Just kind of highlighting on, what, Rob was talking about a little bit, on the core equity side, the quarter was really good. We were up, we added 300 basis points above the benchmark. So it was about 15.2 versus 12.2. And the international equity was, 18.7 versus 16. Really what's happening in the market is a little bit of a rollover in the leader market. Some of the high flying tech stocks, have not necessarily underperformed, but some of the other stocks have started to perform better. Valuation has started to come back into play. I do know that, we don't invest in any small cap, and I know your portfolio does, and, small cap has really recovered as well. And what we're seeing out there is that, is you see the two dynamic markets of, those that are doing well seem to be doing much better, and those that are in need and less well off, are just trying to keep their head above water. I think that what the market's looking today is that the stimulus package is going to be good for those that need it. And when we look at the portfolio, we're kind of balanced, and last year's year-to-date underperformance and the turnaround in the fourth quarter continuing into this year really is, we do have some plays that were hurt by COVID. We do own some Marriott in the portfolio and some Delta Airlines, and a number of stocks in that category, which we think will, as things start to recover, one of those areas will, get back to earning more. I think investors are starting to reward them, but I don't think they're not fully back. Our biggest factor really going forward that we're looking at, across the board is and the biggest risk in my opinion is, once we get through, most of the vaccine rollout, people are feeling better, is that a lot of companies cut capacity, a lot of companies cut just general goods and inventory, and so that sets up for when you get stimulus and everything else, and a little bit more discretionary spending, and you're setting yourself up for a spike in inflation. I think that's my biggest fear really is that inflation starts to heat up more than expected. You are going to see as things start rolling through the downside last year, and you start getting into the June period this year, you're going to see some pretty impressive inflation numbers of, probably 3 or 4% for a short period of time. Now, what does that mean? That probably will stabilize. One of the things also that's happening in the markets is that material costs have been going up. The price of copper has been going up. Essentially all price of steel has been going up, and right now we're seeing that the companies have been able to push through a lot of the price increases, and at the same time, is these companies have dealt with COVID. They've done a great job of cutting costs. So you now have yourself set up for the ability to raise revenue, raise price, and your costs are lower just from cost cutting measures that you've done. So you've set it up that companies should be very profitable for the next 12 to 18 months. So that's, a lot of the general market out there that includes, technology and industrials and consumer discretionary. And so then once you move away from those stocks, as interest rates are going back up, the low on the 10-year was 50 basis points, and today it's about 110 on the 10-year Treasury. So what we're seeing at that point is financials are looking much more attractive as well, because banks are able to make a little bit more money. Short-term rates are very small, so they're able to borrow at very low cost and then lend out at a decent level to get a good return. So we think financials will do well. So it's kind of oil is doing much better. I think that's kind of the wild card in this is that as we start to get demand back, where do we go from the oil side? I know that that could be a political issue this year. I think there's some green incentives, but the bottom line there is that those add value. I think that the increased demand can go there, but the traditional oil and natural gas market is going to do very well. We forecast oil prices to stay here close to $50. So we're neutral on the oil side, but think that fuel costs are the energy side will do well. So it's kind of one of those things where from a historical perspective, if we go back and look, the market is trading at a pretty steep multiple. Where currently on trailing earnings, the S&P is about 30 times earnings. This year's a little bit negative because of some of the downside to a number of sectors that had poor earnings. But 2020 or the 2021 forecast PE is going to be at approximately 23 on the S&P. So we have a slightly lower number, but that's that's a high based on historical numbers. But given where some are where where interest rates are still at historical low numbers, we think that there's some good growth beyond 2021. 2022 will offer still some growth from there. So we think that the markets are at a what I would consider to be a fair value. There's not a lot of alternative. I think a couple years ago, one of the things that one of the big themes that caused the market to go up was there's not a lot of alternative. It's a when you think about where you're going to allocate funds with fixed income at a 10-year or 1%, it's hard to put 40% of your money into fixed income. But that's so people are moving that, but I think there's still we still have a lot of things that are uncertain. And unfortunately the stimulus will eventually come with a tax rate increase. There's that's at the end of the day, that's going to be somewhat of a negative to the stock market. We think that it's will add some risk, but overall, that really looks for some volatility. But going forward from here, we think that stocks are pretty good. They're probably the best alternative to fight inflation in the market because people will have some pricing power. The employment numbers will start to turn around and get better from here, which I think is a good sign. So we're positive on the market. However, that being said, we're still cautious that we haven't completely come out of the COVID crisis. There could be another strain that comes through. So that's makes us a little bit leery. There are made up within the S&P 500. There are a lot of very large tech companies that make up a good percentage of the benchmark that we think are trading at probably high valuations. That there's a couple ways that could correct. One of it is just the rest of the market catches up. The other, you could see a correction in those stocks. And cause the market to decline a little bit. But, overall, we think we're, very well positioned. We're starting to see, we are stock pickers, and we're starting to see that, active management is starting to come around, and, valuation is starting to be meaningful again. We think that will continue. Some of the excesses in the market are, kind of momentum driven, and those are starting to change. And, we think that continues to play out into 2021. And from just a quick note on the international side, it's similar. Valuations are about the same, a little bit better from a P ratio, a little bit lower growth rate. One of the biggest concerns we had coming into last year was what was going to happen if the UK exited the Eurozone. They've come to a better than expected conclusion to that, and they're able to get out without tanking either economy. So we think there's some opportunity there. Look for international probably outperform the domestic side by a little bit, just as we see that same type of a commitment to valuation there as well. And with that, I'll open it up to any questions.
Okay, thank you so much. Any questions?
None here.
Okay.
Okay. I'll do just a quick update on the fixed income portfolio. The portfolio had a good fourth quarter and a very good year. The fixed income portion beat the benchmark by 22 basis points in the fourth quarter, by 52 basis points for the year, and across the board over all trailing time periods. But 2021 was a roller coaster year, no matter how you look at it. The first quarter was devastating to credit markets at the beginning of the year, because of the beginning of the pandemic, sent investors running to the safety of treasury bonds, and the liquidity market absolutely evaporated. Market liquidity was gone. The Fed, the U.S. Treasury, Congress all stepped into short markets. Corporations took advantage of that opportunity and issued nearly $1.9 trillion in new debt, far surpassing the record set in 2017 of $1.36 billion. As corporate bonds got really cheap toward the end of the first quarter into the second quarter, we loaded up on them. As they appreciated thereafter, started to become expensive, we took some profits, reduced the overweight to where now our overweight to corporates is only about 5% over the benchmark right now. Similarly, TIPS, Treasury Inflation Protected Securities, also did well toward the end of the year. As implied inflation rates went from a low of 0.5% to 2%, we also sold off some of our position as they appreciated. In the government agency sector, followed kind of a similar trajectory and actually became more expensive than they've been in 15 years. We took advantage of that by selling them off, taking profits, and rolling into treasury bonds, which is where we have a pretty big weight now as we wait for an opportunity to put some of that money back to work in some of the spread sectors. And then lastly, mortgage-backed securities underperformed treasuries, really as homeowners took advantage of the ultra-low interest rate environment by refinancing their mortgages. We are underweight mortgage-backed securities, but we'll look to add some back, taking some from the treasury position we have now. So looking ahead, we see interest rates rising, with the 10-year going from its current 1.1%, as Bob mentioned, to a high of about 1.5%. So we're taking a defensive position right now with respect to portfolio duration. Our interest rate risk is currently at about 97% that of the index, so we're a little bit shorter. As non-treasury bonds begin to cheapen up, we will reallocate from treasury bonds back into those sectors, as I mentioned, take advantage of the opportunity. So that said, our base case looking into 2022 is for very low single-digit returns in bonds. In 2021. Very low single-digit returns in 2021 for bonds. I mean, the yields are basically non-existent. If interest rates go up a little bit, it'll cut into that yield return. So while we were fortunate to see a 6% return in the fixed income portfolio in 2020, it is virtually mathematically impossible unless we get negative interest rates to do that again in 2021. So, for your planning purposes and expectations for the portfolio on the fixed income side, a very low single-digit return should probably be in the realm of a reasonable expectation. So with that as the overall review, happy to answer any questions. Just if there's anything else we can help you folks out with, glad to do it.
Thank you to both you gentlemen. I think the thing that we always say in Center County is we're really focused on the year end, because that sets our ADC for the following year that we contribute into our portfolio, or I should say our fund, and then it gets distributed out to our portfolio managers. And so we are very excited at the fact that it's coming in better than we thought it would be. And so we're very appreciative of that. Still a lot of work ahead this year with where we need to go with economic recovery. So we just don't hope that our portfolio does well, but also that our citizens do well here in Center County and across the country. So any final questions for our partners at CS McKee before we conclude our meeting today?
One question. What would the increase in interest rates do to the market in general into 2021 or even 2022?
Sure. So on the fixed income side, as interest rates go up,
recording is on.
The value of the bond portfolio will actually get hit a little bit. So you've got some ballast there in terms of the actual yield on the portfolio. But if the portfolio has a duration of 5, let's say, and interest rates go up 1%, the value of the portfolio goes down by 5%. You've got 1% of 1.5% of yield, so the overall portfolio goes down by about 3.5% on the fixed income side. Now, we're not calling for a full percent increase. We're calling for about 40 basis points from here. That's why we're saying low single-digit returns. Bob can speak to the impact of a rising rate environment on the stocks and how much of a headwind he thinks that will cause.
I think that it depends on a lot of number factors, but in general, there, unless you would get to somewhere 2.5%, I don't see it having a material effect on the equity side. There's a case where some of the equity income generated stocks, I think that we've over the last couple of years tried to get the dividend yield of the portfolio closer to the benchmark. Some of those type of stocks that are kind of fixed in alternatives could be helpful as people are looking for ways to get a better yield. So if interest rates went up material, some of that money could flow back to the fixed income market, but I don't see a dramatic increase there from the fixed income side or from the equity side being affected by raising rates. I think that the biggest key will be as you start raising rates and you start getting above. I think that 2.5-3% inflection point will be more of an inflection point on the equity side. So we've got a long ways to go before we get there, but that's when a number of things start kicking in, where companies that have excess risk and have to pay more for debt, et cetera, are there. But I think right now where we're at, there's low rates are helpful to earnings, but there's at the same time they're really helpful to every company that's out there. So I think as rates rise, it'll help on the stock picking ability as well.
So Bob, what you're saying is not until the 10-year gets above 2.5%, do you expect there to be much of an impact on equities? Is that right?
Correct.
Okay.
Thank you.
Sure.
Any other questions? Any other topics we wanted to delve into?
I'm good.
Well, yeah, please go ahead. Oh, okay. So as much as we want to hear more about 2020, I think we're all excited to put the year to rest. And look forward to a very prosperous year this year. Again, we really want to focus on what we can do, and we will look forward to the continued conversations with CS McKee and all of our other partners with our portfolio. So thank you both, gentlemen, for your time today, and we're going to be looking for a motion to adjourn at this time.
Motion to adjourn.
Second.
Been moved and seconded. Any final discussion before we adjourn? Hearing none, all in favor say aye. Aye.
Aye.
Aye.
Aye.
Motion carries. Thank you all, everybody. Have a great day.
Okay, take care, everybody. So long.